Fourth lesson. Entry and exit points. Until now, you have learned how to open a position, its size, value, and how your account will be affected once it is open. You have also learned some important terms, including PIP, lot, margin trading, and leverage. After this lesson, you will be able to understand how to buy and sell, as well as how to determine points of entry and exit. However, before anything further, you will need to learn about two types of analysis: fundamental and technical. Fundamental analysis reflects the news that might affect the markets, while technical analysis, also the more important kind, looks at historic trends to determine the future outlook. For example, say you go to the bank daily. With that in mind, we ask you which are the best days to go to the bank during the week. Your advice would be to avoid going on Thursday, as the bank tends to be very busy on that day. This effectively means you have based your answer on your repeated visits to the bank. Technical analysis is very similar in that sense, and there are several technical indicators that rely on understanding market movements in previous years and months to shed light on what you could expect in the future. Of these, one of the most important indicators is support and resistance. For example, prices hit a threshold, start rising, then falling, hitting that threshold again, after which they start rising one more time. Therefore, in the third instance, when prices fall and hit that threshold yet again, it is very likely that the ensuing rise will be higher this time around. This is what is called the support line and reflects the fact that many traders and investment houses at banks observe this movement and buy at the same point all at once. So, what happens after there's a good general price increase? Do you sell? Of course not. You will simply close the position. In the world of Forex, buying is all about opening a position and closing it at a certain point. By the same token, selling is all about opening a position with the intention of selling and closing that position when the required price drop is reached. This is a very important point because selling is akin to buying "currency." If the price drops, you would have made a profit. Before we reach a conclusion, it is important to understand how to read Japanese candlesticks and what information you can extrapolate from each candle. There are two types of Japanese candlesticks: continuation patterns and reversal patterns. Let us start with the continuation pattern candlesticks. The first thing we can learn about these is their green color. Though this may differ depending on the platform you use, it is nonetheless a continuation pattern candlestick, starting from a certain price known as the opening price that may drop, forming a tail. Once it reaches the bottom of that price, known as the least price, it starts rising again, forming a candlestick. It will continue rising until it plateaus, after which it reaches a closing price. All of this information can be extrapolated from the Japanese candlestick. Of course, a reversal pattern candlestick gives us the same information, albeit with a closing price that is less than the opening price. Also noteworthy, each candlestick reflects a certain time period in accordance with the time you have chosen, which usually ranges between 1 hour or 4 hours or even 1 day for long-term traders. So far, we have come to understand the basics of this field, meaning you could start investing from now on. This is the first step in a very long journey, and with time, you could only become more sophisticated at what you do. In the next lesson, we will show you how to implement what you have learned thus far on a trading platform and how to open a real account. See you then. Aronson. Trading, social, simple.